Hello and welcome back to the Pension Confident Podcast. My name is Philippa Lamb. Last year, we discussed the pros and cons of pensions versus ISAs and which was the smartest place to put your savings. Today, we've got another head-to-head, pensions versus cash. Now, since the start of 2022, the Bank of England has raised the base rate 13 times. So it is no surprise that savers are reconsidering where to put their money. But you know where you are with cash, right? Put it in a savings account in your bank and it's there when you want it. But if the interest rate you get doesn't keep pace with inflation, those savings could actually lose purchasing power over time. With your pension, well, you'd usually expect your money to benefit from long-term growth, but you can't get at it. It's locked away until you reach your retirement age, and that could be decades away. So what's the answer? Easy access to your money or make it work harder? Or can you have the best of both worlds?
If you are putting money into something that's not cash, can you still access it? So stocks and shares, for example, can you sell them if you need to?
Immediately.
Perhaps controversially, I'm not sure that I think 3 months is a lot to have in cash. I think if you talk to financial planners, they'll typically say it's between 3 and 6 months.
Today's guests are trying to get their teeth into those questions. Holly Mackay is the founder and CEO of Boring Money. That's a financial website designed to help normal people cut through the jargon and better understand their savings, investments and pensions. Hello, Holly.
Hi, Philippa.
From PensionBee, we're joined again by Martin Parzonka. He's their VP product and we've had him on the podcast before. Welcome back.
Thank you. Happy to be here.
The usual disclaimer before we start. Please remember anything discussed on this podcast should not be regarded as financial advice or legal advice. And when investing, your capital is at risk. You two are going to hate me now because I've got a little maths question for you.
Morning maths. Awesome.
I thought we'd start with the tough ones. Okay, imagine it is 5 years ago. It's 2019. You go shopping, you spend £100 and you come home with big bags full of shopping. Here is the question. If you went out today and bought the exact same items, how much do you think you'd have to spend?
5 years. Well, we know inflation's been pretty ugly.
Yeah.
And we know it got to over a high at one point of 11%. So I'm going to guess about £25. I'm going to guess about £125 because I know you get, well, everyone knows that, right? You just go to your local supermarket. You don't get as much for that same 100 quid. So 125.
125 from Holly. Martin.
I think inflation has been, as you say, running about 11% recently. I think the stats I saw were the basket of goods probably about 30% higher, depending on what it is.
So you're saying £130?
Yeah, 130.
Holly wins.
Yes!
£123.38. But pretty good, both of you, I've got to say.
In 5 years.
I know, it's a lot. It's a lot,
That's
isn't it?
hardcore.
I mean, that's inflation in a nutshell. Just one of the things we need to balance when we're thinking about where to keep our savings. Let's start with the obvious question on that. Why wouldn't you keep all your money at your bank in a current account or a savings account? It's simple, it's safe. Why not?
I mean, I might jump in there. The first thing I'll say, possibly controversially, is if people have any form of cash savings, your bank it's highly likely that's the worst place on earth. You could leave your money in your bank's current account because one thing with particularly the high street banks is loyalty simply does not pay. So if you're banking with any of the big names out there, do not assume that they will look after you. Because the reality is they don't. So we have to shop around. We have to look at other options for our money. And it's easy, isn't it? You know, life's busy. There's 3 million things to do on that to-do list. But if you have any sort of sizable chunk of cash savings and it's in your current account, honestly, you may as well sort of finish listening to this podcast and go and throw some money out of the window because you're not getting what you should be.
Okay, what about bank savings rates? I mean, is that better if you put it in a savings account?
I think they prey on inertia as well. So they know that you're in a current account. And like Holly's saying, they're not going to do much for you because you're there already, right? People don't
They've
like to
captured
switch.
you already.
They've captured you. And so they'll push savings accounts at you, but they're actually not that much better because they just rely on you to go, easy option. I already know this bank. I'm just going to open that savings account. And oftentimes they're also not that great. little bit better than the current account, but they lock you in and you could get better rates elsewhere.
Because they do play on the idea that we think it's quite hard to move accounts as well, don't they? Which now, it really isn't, is it?
No, it's really much easier than it used to be. And the new bank you move to will quite often do a lot of the heavy lifting for you. And just to give people a sense, I mean, in my particular sort of bank, the current account, the attached savings account there currently offers around about, it's under 2%.
Really
but it's
low.
not hard to go out there and find sort of rates that are double that. So I think shopping around is a really good idea. You know, there's not just one pot of money. This is what we tend to sort of think about. What shall I do with any spare cash I have? There are lots of different pots that we can use. And so I think it's really important to think about, what do I actually need that money to do for me? And it might be you have some money in an easy access savings account. There might be some you can set aside for a year, say, and then you'll get more interest on that. So I think the first exercise is mentally think about the jam jars, you know, and what are you going to put in each of them? What do you need your savings to do for you?
Yeah, so stop thinking about it as just a pot of cash.
Yeah, for sure. I like the jam jars concept. There's also,
Yeah.
to remove some inertia, there's products out there that not offered by high street banks necessarily, but that roll up cash. Like I'm someone that I don't really like cash, whether it's controversial or not, and my risk profile is different, a bit younger, so I like to make my money work for me.
Yeah.
That said, you still want to have some cash on hand for, you know, bills. Obviously, you need operating money to do stuff, to buy groceries. What you want to be able to do is take the thought out of saving that. So there are some products out there that'll just roll up or round up money that you've got, that you spend, put it somewhere else, and they generally have a higher interest rate than a high street bank. Yeah, that's something to consider as well.
I mean, in fairness to bank accounts, I suppose we should say, I mean, there are no complex investment rules here. You are saving, you're not investing, really. So, you know, I guess that you can think of that as a plus point. And I think a lot of people do, don't they? Think, I understand this. I put the money in the bank. There's nothing complex here for me to understand. If I want it, I can get it. But we should not be thinking that.
You're absolutely right. With cash, you know the deal. The deal's pretty clear. But I think we're just saying make sure you get the best deal out there. And actually, you know, there are quite often it's the challenger banks. We've talked about some of the newer brands out there. They're hungry for new customers.
Yeah, they work hard
They're
for
the
you.
ones with the good rates. And actually, they're the ones with the better mobile experience as well. So it can be super easy to set up an account. You know, you could do it within 10 minutes, sort of on a commute, really.
So as you say, ideally, you know, we want to keep some cash handy. I think everyone feels that if you can, just in case. It's that just in case feeling, isn't it? If we're thinking about that jam jar, the kind of the cash I like to keep where I can get it whenever I want it, how much should we set aside? And I'm not talking about a figure here, I'm talking about a proportion, really.
The rule of thumb is 3 months of expenses. I think it's important, again, where you are in your life stage and your risk profile, to make your money work for you. But you've got to just look at what you can do without. So if expenses do come and there is something unexpected, make sure you can actually at least draw down from your investments. So what I mean by that is, if you are putting money into something that's not cash, can you still access it? So stocks and shares, for example, can you sell them if you need to?
Immediately.
Right? And oftentimes it is pretty liquid, which means you can get the cash out of that quite quickly. There is obviously a risk with that. If the markets have gone down, you might be selling at a loss,
Yeah.
which you need to be ready for.
Yeah. I mean, if we're thinking, I've always thought 3 months sounds like a lot. I understand it's a nice idea, but if you add it all up, it's a lot. Can we maybe drill down into the actual bits of that expenditure that you really do need to save for? Because we all spend a lot of money over the course of 3 months, and some of it we probably don't need to spend, do we? So is it about actually picking the bones out of that? You know, it's the rent or the mortgage payment. What do you think, Holly?
I think, perhaps controversially, you know, I'm not sure that I think 3 months is a lot to have in cash. I think if you talk to financial planners, they'll typically say it's between 3 and 6
Yeah.
months. Now, I know that sounds like huge, but then you sort of think, okay, we're not in the most certain sort of environment at the moment. What would happen, say, if you lost your job? You know, what would that mean for your rent payments? So it's just that sort of that comfort blanket around us. Of course, if you've got kids, tell me, you know,
Yeah.
the never-ending, voracious, cheeping beaks that need to be fed, you know, you sort of factor that in. So it does depend, I think, if you've got dependents or not. For me, it's 3 months as a minimum, as a starting point for our financial plan.
So if we're thinking about that as one of your jam jars, and I really love this jam jar idea, is that a savings goal in itself? If people are listening to this thinking there is no way I could set aside right now 3 months' money, let alone 6 months' money, is that the first thing you should be saving for, actually? Your emergency cash jam jar.
Absolutely. That for me is the sort of, I think we all have steps on our financial journey, and there's an order we should do things in. The first, actually, even before that, would be to pay off any expensive debt. So once that's done, then absolutely, I think sort of people's first goal is to get to that sort of 3 months of outgoings.
And just to spell out the reasons for that, it's if you've got debt like that, you're paying far more in interest than you will gain wherever you put it in savings. So
in savings, in ISAs, in whatever it might be, is getting rid of that debt is the very sort of first starting point.
Actually, with the base rate increasing, I think credit cards now are like 30%.
Some of them.
It's insane.
Insane. So if you're not paying that off every month, that's a huge bill, isn't it?
Yeah.
Just sticking with cash, are there any downsides to holding a lot of cash in savings? I'm thinking about state benefits here. Do you risk losing access to state benefits if you've got quite a lot of cash saved?
If you carry too much cash, or too much inverted commas, it can affect your pension credit. So if you have 10,000 or less in savings, it won't affect your pension credit.
Just remind people what pension credit is.
So it's the amount of extra money that the government will give you if you're on a low income and you're of state pension age.
Okay. Other benefits that you might risk if you're holding too much cash?
Cash can also impact your universal credit, which is a payment to help with living costs if you're on a low income. So £16,000 is the cutoff point of savings you can have before universal credit is impacted.
So just to be clear, and it's your cohabiting partner as well, isn't it? If you've got £16,000 or less in savings investments, that's not a problem for universal credit. And I'm assuming here that pension savings, we're going to get onto pensions later, they don't count towards this. That's not a problem for benefits.
No, that doesn't affect your pension credits.
Shall we move on to the options about where you keep this cash cushion we've been talking about? Best places?
I think we have to not just chase headline rates. For me, it's about what institution is looking after my money. And I have to say I'm a big fan of NS&I. That's backed by the government. So for me...
This is national savings.
That's exactly right, national savings. NS&I is backed by the government. They're the last man standing, effectively. If everything goes to pot, everything goes to seed, NS&I should be the last financial institution still there. They won't always pay the best rates, but they're typically pretty competitive. And I feel very secure having my money there. And that for me is a consideration when we're looking at financial institutions. Typically some of the sort of sexier brands out there are some of the newer ones. And I sort of do worry a bit about how are they funded, who's behind them. Of course, money is protected for us by the government. If a bank or a financial institution signs up to what you will see online as FSCS, the Financial Services Compensation Scheme, then anything up to £85,000 is typically safe with that institution.
On the topic of FSCS, I guess shameless plug, we're at PensionBee, the way we structure our investments, they are jargon, but life-wrapped policies, and so they benefit from 100% protection. If the financial institution that holds that investment, so with us it's either BlackRock, State Street, or Legal & General, honestly, if one of those goes under, there are big problems in the world.
Yes, globally.
That said, a customer's funds are protected up to 100%. Now, it's important to note that when we say, safe in inverted commas or safer, it doesn't mean that money can't fluctuate, and if markets do drop, the money will drop. So customers aren't protected from that, but they are protected from those institutions defaulting or going bankrupt.
Yeah, so these are all significant. I mean, it takes a while to save the money. You don't want to lose it, do you, if things go badly? What about cash ISAs?
The whole point of a cash ISA, I think, is I love ISAs. They're sort of like Tupperware pots. You stick your money in and the taxman can't get his hands on what's inside that pot.
So it's not a jam jar?
It's not a jam jar. God, you can tell my food allergies. I'm feeling a bit greedy today. They're in that sort of pot. And this is really important because the tax take for all of us is going up and up and up and is just going to keep going up. So ISAs are awesome. But, spoiler alert, we also get a certain amount of money every year we can earn in interest and not pay tax on, whether it's in an ISA or not.
And that is currently?
That is the personal savings allowance. It depends on how much tax you pay. If you're a higher rate taxpayer, you can earn £500 a year in interest before you pay any tax on it. If you're a basic rate taxpayer,
Which is most of us.
Yeah, you can earn £1,000 a year in interest. So for me, the smart move, I think, is to look at your first sort of lump sum of money, any cash savings, and go for the good rates. And quite often, those are not in cash ISAs, but just make sure that the interest you earn on that every year is not going to go above that personal savings allowance. So £500 if you're a higher rate taxpayer, or £1,000 if you're a basic rate
I
taxpayer.
mean, that's a lot of interest, isn't it? I mean, most people are not going to be getting that much interest on their savings, and so they're not going to be paying any tax regardless.
And with current sort of interest rates as they are, to give you an idea, if you're a basic rate taxpayer, that would be about £20,000 in a savings account.
Yeah.
That would generate about £1,000 a year. So it's quite generous. So for me, cash ISAs are not quite as shiny as they once were because we've got that personal savings allowance.
Interesting. What's your take on that?
Yeah, I agree. I think if you're going to take advantage of ISA allowances and the benefits that come with them, stocks and shares ISA, because that way you've got risk on, so you've got your money working for you. So investing in stocks and shares in that ISA, generally speaking, markets will outpace inflation and interest
Over the long term.
over the long term. And then the benefits of not paying tax on that gain is better than not paying tax on the interest gain. And like you say, Holly, you could save that money somewhere else in a savings account that's not in an ISA and still get the benefits of not having to pay tax on it.
But we're back to the jam jar idea. But this is starting to sound like a plan, isn't it? However small the sums are. And it is important to say that, I think, because when you have these conversations, I think a lot of people listen to it and think, all I'm talking about is maybe I could save maybe £50 a month. So why are we even having this conversation? But actually, still worth, thinking about that.
£50
Well
a
worth
month, yeah, can be huge. I mean, I started working in finance in Australia where ages ago, eons ago, pensions were compulsory, and my employer set it up for me. And they paid in, it was probably about $40 a month.
Right.
And I remember at the time sort of going, well,
point of that?
that'll buy me loads, won't it? And then I moved back over to the UK, sort of forgot it was there, and then sort of tidied it up a few years ago to bring it over. And I was like, oh my God. Because we talk about compounding quite a lot. Here's another analogy for me. I think it's like building a snowman, and you start off with a tiny little ball of snow and you roll it around your garden forever, and you think, oh, blimey, I'm going to be here all day. And then just towards the end, the bigger the snowball gets, the quicker it grows. And the same is true of our money. So I would say to people, even if you start a pension and you put in £10 a month, it doesn't matter. It's just the first step is getting started, and it does grow. That snowman does kick in.
See, I'm worried about the snowman idea, because my idea of a snowman is that then you build this snowman and then it melts.
Well, I guess the melting is maybe you spending your pension in retirement, swanning around the world, having a laugh.
Hi, it's me, Philippa, just interrupting for a moment to say a big thanks to all of you who've subscribed to the Pension Confident podcast. Our mission is to help you feel more financially confident, and we are thrilled with the community we're growing here on YouTube. If you haven't already done it, hit that subscribe button right underneath this video so you never miss an episode. Meantime, enjoy the rest of this month's conversation. But what you say is absolutely right. And I think this is a good moment. Let's leave cash behind for a moment, talk about pensions. I mean, the basics, they can be hard to understand. I think there's no denying it. They can feel very complicated to ordinary people.
I wish I was in charge of marketing for the government, because I'd run a really good pension. Pensions are hot.
Go on then, give us your elevator pitch for pensions.
Well, you get kind of free money. I mean, if you're a basic rate taxpayer, and you put £80, let's forget the word penny, you just put it into this account thing. You put £80 into this account thing. The government sort of wave their fairy wand, and up pops another £20 in that pension account. So that £80 becomes £100. Just like that. You don't have to do anything other than put that money in. And I think that's really poorly understood as still we don't explain that core benefit to people very well. Now, why does that happen? It's basically sort of bribery from the government. They're kind of patting patting you on the head, Philippa, and saying, Philippa, we'd really rather not have to pay for everything you need when you're really
when you're old and needy.
So please, Philippa, be a good girl, put £80 in a pension, and to encourage you, we'll give you back all the tax you paid on that money, roll it all up. So bingo, you've got £100. And that is such a sort of fundamental benefit. It gets even hotter, Philippa, for sort of higher rate taxpayers, because not only does that happen for them, but when they come to do an annual tax return, they get effectively another 20 quid on that £80 because you reduce your income in that tax return by another sort of element because you're a higher rate taxpayer, you've paid more tax, so you're getting more tax back. So if you pay into a pension in any one financial year, when you come to do your tax return, you will be high-fiving yourself because you can reduce that taxable income. And that's a nice feeling in January.
Yeah, absolutely. At any time of the year, I think, isn't it? And as you say, the chunks of free money here, they are substantial, as a proportion of what you're saving. They really are. I think it's worth talking about workplace pensions here as well, because as you mentioned, Holly, your employer back in Australia lobbed this, what seemed like a very small amount of money into your pension pot at that time, years ago. And then it just rolled up and rolled up. This is free money from your employer, isn't it? And auto-enrolment. The government's bid to make us all jump into that, that method of saving, that's been very effective, hasn't it?
It has, yeah. There's a couple of things also to consider is that a lot of employers will match the contributions you're making into a pension as well. And so if you don't contribute yourself, they also won't contribute. And so you're losing out twice.
Ah, yeah, that's a good point.
Yeah.
Yeah, I think everyone listening, it's really worth, if you don't know, this particularly happens with larger companies, bigger brands. If you don't know, get on the phone to HR, look on the intranet, whatever, find out about this matching. If your employer matches in your workplace pension, then that is what I'd call a no-brainer, right? Because if you put in, as Martin's just said, another 1%, they will give you another 1%. That's like getting a 1% pay rise.
Yeah, right there, isn't it? I mean, they put ceilings on this, don't they? There's a limit how much they'll let you pay in because there's a limit how much they want to match, but worth doing.
For most of us, that sort of, we won't sort of reach, I don't think, that sort of limit. So it's really worth sort of investigating. And if they do match, and there are those extra contributions, there'll be very few other places where you can get such a good return on your money.
Just on the point about few places you can get that kind of return on your money, just going back to the tax relief point that Holly was talking about earlier, it is, yeah, you're so right. It should be shouted from the rooftops. Where else in the world will you get 25% instantly on the money you put away?
Yeah.
That's an amazing return.
Unless it was some crazy scheme where your money would be very much at risk.
Yeah, exactly right.
And blow up horribly.
Yeah, exactly. Terribly bad idea. If someone's offering you 25%, I think largely you have to be asking some questions about that, don't you? Okay, if you've been signed up for your workplace scheme, what are the arguments for setting up a personal pension as well? Why would you need to do that?
Yeah, really good question. The benefits could be that you may want to diversify, not have all your eggs in one basket. Although that said, most plans that you would invest into in a pension are diversified anyway. You put money.
So when you say diversified, you mean
having money in the US markets, having money in UK markets, in emerging markets, Asian countries, African countries. It's good to have that sort of spread.
And pension funds don't just invest in stocks and shares, do they?
That's right, yeah. It'll also be bonds, cash. There'll be some money held in cash as well. Commodities, property, pretty much anything you can put money into.
So commodities being things you make stuff out of, copper, gold, that sort of thing.
Oil, yeah,
all that sort of thing. So they have this very diverse, to use your word, range of investments, and that essentially is all about insulating you from risk, isn't it?
That's right.
If something goes badly, hopefully something else is going well.
Yeah, and it's important also to have a look at the type of investment plan you're putting your money into. So not all plans are like that. Some will just be 100% company stocks. And that's okay, depending on your risk profile. If you want that, you can have that. Some people don't want that kind of risk. They want it 100% in bonds. That's okay. Maybe 2 years ago it wasn't okay.
Yeah.
Bond markets were interesting, but
personal choice.
Yeah, personal choice, exactly. So yeah, that's the point of diversification. So we got into this point also from your question about why would you set one up as a personal workplace
why
pension?
would you have one as well as a workplace pension? It's all money out of your spending pot every month, isn't it?
Yeah, that's right. So one of the things you can do by having a personal pension on the side is that if you do move employers, you can just have that with you all the time. So roll that employer pension into your personal pension. Next employer, go to their scheme, leave them, roll it into your personal pension again.
I think people don't know this, do they? And this brings us to a point we make so many times on the podcast, but it's worth saying again, you need to understand what your pension is all about. Ask your employer, don't you? Get them to tell you, because they hand you a bunch of stuff on day one, you don't read it, you forget about it. Most people have no idea what their workplace pension is investing in, or what sort of
even
deal
what
they're
it's
getting, or
worth.
what it's worth. But your employer has to tell you all this stuff, don't they?
And there will be a website. I mean, some of the websites will be pretty dodgy. You'll be looking at it thinking,
What does this
this
mean?
was built in 1994.
Yes.
But there will be a number there. It will tell you how much you've got in it. It will tell you what the fees and charges are. And it will tell you where your money is invested.
So that's definitely worth doing. We always want to know where our money is and what it's doing. I think that's the lesson here, isn't it?
And how much it is. Just getting that number is kind of vital. It's a sort of first step, really, in sort of sorting out. We talked about jam jars earlier.
Yes.
It's just working out what you've got in every jam jar before you work out what to do with it.
So we've said lots of great things about pensions, and indeed there are lots of great things to say, but I'm going to say, tell me about the downsides. And the first one that comes to my mind is you can't get the money, can you? Not till you retire.
It's locked away, yeah.
That's true. But, it's actually not locked away that long. It's 55 right now before you can draw down from a pension, but 57 in a couple of years' time. And it'll keep increasing, likely, as people, we're speaking about longevity earlier. People are
Yes.
living longer, so it makes sense that you can't access your pension for a little bit of time. Interestingly, though, the UK, 57 is actually quite young. In Australia, it's 67, right, before you can access...
Is that right?
Yeah, there are benefits here to putting your money into a pension scheme. The other benefit is that the first 25% that you do draw down is tax-free. So, that's pretty cool.
And when you say drawdown, you mean
take money out of the pension.
Take out.
Yeah, the main downside is locking it away for a while. But
Yeah.
honestly, like I say, it's quite young still. And if that's the only downside and you get 25% free money instantly...
Hang on, Martin, I'm going to cut it.
Okay,
57,
Holly, go
there'll
for
be,
it.
well, to me, it might not seem that long away. She blushed. Thank God this is a podcast,
Full
not
disclosure,
telly.
Martin is the youngest person in the room.
Yeah. Philippa, how do you know? But I think for people, particularly people in their sort of 20s, 30s who are thinking about buying a property, you're cautious about locking your money away into a pension. And this is where I think for people under 40, an alternative is the lifetime ISA. This is a sort of a vehicle where you can pay in up to £4,000 a year if you're under 40, and the government will match that with up to £1,000 every year. So that's a total of £5,000 you could save there. There are catches with that. You have to spend that money either on buying a first property, or if you change your mind and decide not to, you can then use that for retirement. If you change your mind and take the money out sooner, you get clobbered with punitive rates. So
Okay.
you have to be pretty damn sure that you're either going to buy a property or use it for retirement. But that is a vehicle that does give people who are saving for a property a bit of flex. It is an alternative to a pension. There are pros and cons to both. But particularly, I think, for self-employed people who don't have those workplace contributions, it's an interesting sort of tax wrapper to have a look at.
Yeah, I mean, it's a fair point about the employer's contributions. If you're not getting those, it's a bit of more of a straight question where you want to put your own money, isn't it, Martin?
Holly's right. Lifetime ISAs are quite beneficial because you do have that option to, either take it for retirement or for a property, first property. But I think there's caps as well to that, so it could make sense to have both.
Yeah, we're back to the both, aren't we? We're back to the
More
do it
jam
all.
jars.
Yeah.
More jam jars.
Kitchen's getting very busy, Philippa.
I know, but honestly, I'm kind of thinking, is this the lesson from this podcast? That's what it is. However much you've got or however little you have, do not imagine that it just needs to go in one place.
And I think that's really key, and it's that sort of visual, what do I want this money to do for me? And there'll be different things, different sort of time frames. We've talked about the 3 to 6 months of sort of disposable income. That's sort of one jam
Safety
jar.
cushion.
Then
Yeah.
the sort of furthest, sort of longest one down the track is the pension, but there's other pots to it. And an important message is they can all be quite small, because I think for younger listeners in particular, it's as important to get started and to set the habit as it is to sort of think that you're having an enormous financial impact.
Yeah, particularly with a pension.
Yeah.
I suppose, would we add to that, don't ignore your jam jars, because if you're paying tiny amounts in when you're 22, when you're 32, all being well, if you're earning a bit more, you should be ramping up your jam jars and making your jam jars bigger. Yeah, you can't just keep on paying a tiny amount into your jam jars. And expect it to go
nice
well.
tip there, pay yourself first. So whenever you get a future pay rise, you can't miss money you've never had. So the first thing you do is set up a direct debit to come out on payday so you can't spend it, and just hoik it up. Kind of do it every, hopefully, year and align it to a pay rise.
So the wealthier you get, the more you should be saving.
In theory. Sounds crazy, doesn't it? But it's true.
Avoid lifestyle creep. Just, I can get a nice flat white. I can go and get a better flat white. Or I could just put that money away, right?
They'd all cost £4 in London anyway.
I think we're going to wrap it up there. Really good advice. I mean, there is always so much more in these things, isn't there, and you think about, but really helpful tips. Thank you very much.
Thank you for having me.
We'll be back next month exploring the question, can money buy you happiness? I would like to find out. Seriously, though, there is a lot to talk about in this one. We are really going to try and get a solid answer on it. So it's going to be well worth listening to. Meanwhile, please leave us a rating and write us a quick review in your podcast app. You know we love to hear what you think about every single episode. Remember, you can find us on YouTube and in the PensionBee app too. Just before we go, always remember anything discussed on the podcast shouldn't be regarded as financial advice or legal advice. And when investing, your capital is at risk. Thanks for being with us.